Welcome back to part 2 of our in-depth breakdown of the Dhandho Investor by Mohnish Pabrai. In part 1, we covered the foundation of the Dhandho philosophy: low-risk, high-reward bets with limited downside and strong upside. Now we dive deeper into Pabrai's investment principles, focusing on how to identify and execute Dhandho opportunities in the real world. Pabrai lays out a simple yet powerful roadmap to guide investors through the process of making calculated decisions. One of the key concepts he introduces is invest in existing businesses. Instead of speculating on new ideas, look for businesses that are already working. These are companies with a track record, preferably for decades, because history can reveal how well a company performs through different market cycles. Why existing businesses? Because they're easier to understand. You don't need to guess what the product will be or how the market will react. You can see how it has already reacted. And if the company has survived downturns, recessions, and competitive threats, that's a sign of durability, an investor's best friend. Next, Pabrai stresses, invest in simple businesses with predictable futures. Complexity is the enemy of successful investing. If you can't explain what a company does in 1 or 2 sentences, it's too complicated. Pabrai loves businesses with a straightforward model, ones that make money in a clear and repeatable way. For example, think of Coca-Cola. It sells a product that people love, and they keep buying it, over and over again. There's no need to overthink it. Pabrai urges investors to focus on this predictability because it helps remove a lot of uncertainty. Predictable businesses make forecasting future earnings more reliable. Another cornerstone of the Dhandho framework is invest in distressed businesses in distressed industries. This may sound risky, but Pabrai shows that it's actually one of the safest ways to invest if done correctly. When an entire industry is out of favor, think airlines after 9/11 or banks during the 2008 crisis, great companies can be bought for pennies on the dollar. The key here is to distinguish between temporary distress and permanent damage. A good business going through a bad time is exactly what Pabrai looks for. The market tends to overreact to short-term problems, creating opportunities for patient, contrarian investors. Pabrai also advocates for what he calls buying businesses with durable moats. A moat is a company's ability to protect itself from competition. This could be a strong brand, network effects, or cost advantages. If a business has a moat, it's more likely to maintain its profitability even as competitors try to take market share. Let's not forget the principle of buying at a significant discount to intrinsic value. This is straight from the Buffett playbook. If a business is worth $100, you should try to buy it for $50. Why? Because that margin of safety protects you if your assumptions are off. The bigger the discount, the lower your risk and the higher your potential reward. And what about portfolio size? Pabrai keeps it simple. He recommends investing in no more than 10 bets at a time. This allows you to focus on your best ideas and avoid dilution of returns. He calls this focused investing, and it's how you capitalize on the power of compounding. In this part of the book, Pabrai also warns about emotional investing. Fear and greed are powerful forces. Dhandho investing is about logic and discipline. It's not about chasing trends or reacting to market noise. It's about knowing your business, knowing its value, and having the courage to act when the price is right. So let's recap. Part 2. Stick with existing, proven businesses. Look for simplicity and predictability. Seek out distressed industries for bargains. Always demand a margin of safety. Focus your portfolio. Stay unemotional. In Part 3, we'll look at Pabrai's checklist approach to investing, his thoughts on cloning great investors, and how to avoid the biggest pitfalls that derail most portfolios. If you're enjoying this series, hit that subscribe button and join our community of smart, long-term investors. Let's continue building wealth the Dhandho way.